The middle class is about to get screwed. In this video, I'm going to explain how that affects you as an individual and how it could affect real estate and the stock market. And it's not going to be what you think. It's going to be pretty frustrating and really good for some folks. Here we go. First, we just had a jobs report that came in roughly in line with the pre-pandemic, which seems good, but it totally missed expectations. We were looking at 240,000 on a survey, and we got 175,000 jobs. That's not good because it means for some reason the data we're getting is not aligning with what economists are actually looking at, suggesting that maybe underneath the surface some worsening trends are cooking that aren't good and being picked up by economic data. In fact, for this jobs report, there were 76 qualified economic analysts and corporations coming up with these estimates. Only 2 of them were looking at a number under 175,000, and all of them, other than 3, were above 200 or equal to 200. So in other words, how did 73 out of 76 economists, over 90% of the economists, get it wrong? Well, it's possible that there's more of a weakening and it could affect your stocks, real estate, and importantly, your job. Look at this earnings call from ZipRecruiter. This earnings call for ZipRecruiter suggests 2023 demand for recruiting services dropped throughout the year for all company sizes. In this earnings call, they actually talk about how it started with small companies. It started in the SMBs, the small to medium-sized businesses, but it actually ended up expanding to larger enterprises as well. In fact, yesterday we made a video where we talked about how it looked like there were some anecdotes about people over at YouTube Music getting laid off because AI was starting to take their jobs. We could see more of that. But not to be redundant to yesterday, it's important to just use that as a reference point and add more data to that, which is ZipRecruiter being concerned that not only are we seeing quits back to pre-pandemic levels, which is somewhat being referred to as, dare I say, the great staying. Digest that one for a moment. Remember that back during COVID, there was sort of this great resignation. Now, folks are actually calling this the great staying or the big stay. Take a look at this. The executives over at ZipRecruiter say the great resignation has turned into the big stay. And we see that as something that is working through the system after the tumult of people starting to shelter in place during COVID. A great reshuffling in terms of the big resignation, the great resignation, and now sort of digesting that stuff. But the problem isn't so much, okay, the recruiting company is having issues. It's where is the labor market going from here out? And right now, ZipRecruiter says that the labor market is flattening out. But throughout the entire earnings call, they say usually what happens is it flattens out and then it declines further. They don't actually know if the Q4 peak that they saw in terms of pain for the labor market is the peak or if we're just flattening out to fall off again and basically get even worse data. So when I say peak, I mean the worst bad. So like the peak of bad data, right? We don't know if that's flattening out or it's going to get worse, but we do know that usually, let's say up is bad for them. So you peak out Q3, Q4, the entire year things get worse. So they see out a little bit of flattening. And then usually when they see a flattening, they start seeing data get worse again. And again, I'm going up here to imply more unemployment, the way to think about this. So ZipRecruiter's not happy. They're saying, look, if things get worse, we're ready to be nimble and cut more expenses. It's not just ZipRecruiter though, it's also other companies like Randstad. Randstad is a company from Amsterdam, but you might know that company a lot better by its US sort of name, and that's Monster.com. Monster.com is owned by Randstad. And in their earnings call, they indicate the same thing. They suggest that basically the labor market is pretty soft across the entire world. Germany is getting hit hard and it's not getting better. France is getting hit hard. North America is getting hit hard. And this all has to do with new hiring. That's a leading indicator that suggests problems could be coming for people's jobs. So in other words, if you're part of the middle to upper middle class and you lose your job, it could be really hard to get a replacement job. So what then happens, and how does this relate to Jerome Powell and the Fed? And how does it relate to what could happen in real estate, and what could happen with foreclosures, and what could happen with the stock market? Let's analyze this. First, Jerome Powell was weirdly dovish on Wednesday. Why was he so soft? We were not expecting that. We were expecting more of a neutral Powell, but we got a pretty dovish Powell. Well, as I tweeted this morning, you should follow me on Twitter or X at RealMeatKevin. Now we know why Jerome Powell was dovish Wednesday. As suspected, and he's told us this, so it's not a big secret that he knows this data oftentimes beforehand. He can kind of call into the Bureau of Labor Statistics and get some tentative data before it's released to the public. And so calls in, as suspected, Jerome Powell likely had this jobs data before his FOMC speech. Now we know why he was dovish. Much weaker jobs report than expected with less wage gains. Not great. Now we understand why Jerome Powell is picking up on the leading indicators and he's going dovish. This is not a matter of flip-flopping with the data on the Fed or whatever. This is a matter of seeing this transition happening at the Fed. And we're trying to understand, why is the Fed biased to want to cut? And boy, you got to see what just happened with rate cut expectations. And again, this is going to lead to what happens with real estate and stocks. But first, I just want to shout out that we did extend this just briefly to today, the Stocks and Psychology of Money group and the buy-sell trade alerts. This morning, I threw what I thought was a risky bet on a call option, but I played my trading analysis lines almost perfectly. I go, we could get a breakout on this line. I think we're going to go from this line to here. It was end phase, 113 to 118. I'm throwing $4,500 on this. Boom, 5x baby, 20K on the trade today. I post my P&Ls. If you want my buy-sell alerts, make sure you're part of the Stocks and Psychology Money group, link down below. We are going to officially raise the price this evening, so check that out. But what's very important now is, how does Jerome Powell's dovishness and these worsening leading indicators affect inflation and then the greater market? Well, remember, Jerome Powell doesn't seem convinced that there's going to be a second wave of inflation. If you're a second wave of inflation person, you're probably going to want to be heavily exposed to cash, not personalized financial advice, because things are probably going to get a lot worse. But I want to show you an example of how companies, when they've been used to raising prices for a while, they tend to be a little sticky in when they reduce prices, and that's because of ego. Let me show you one of the most egotistical companies I've discovered, and I have to say, it's a scary sight. It's really scary. It's really disappointing because I used to have a lot of respect, and now it's just clear to me that this is nothing but ego. And so I'm going to put this picture up on screen. I just don't want you to be scared by this. Here it is. Go! Sorry, wrong one. It's right here. It's the Starbucks earnings call. So this is the Starbucks earnings call. Starbucks went all in on building out Starbucks in China. And the thought was that they were going to be able to bring premium coffee to China. And by bringing premium coffee to China, they would basically double their market and be able to substantially double their revenues. That's what restaurants and food and beverage companies do. They build more locations so they can grow. So your goal is build, so you get more and more and more revs, so your stock can go up, your earnings go up, and you get more scale as you're buying stuff. But I want you to listen to just this and tell me what you think about the Starbucks ego here as they face problems in China. You ready for this? I'm going to hide myself and read it out to you. Here we go. Actually, you know what? We'll take the laser pointer. So let me start with competition in China. I think the growth that's taking place in the mass area of the China business, of the China overall coffee and tea segment, is one where we just see intense price competition. Okay. Remember what happens after intense price competition. First, you have too little of a product. Like, think AI, okay? Oh my gosh, we have too few AI chips. We do not have enough AI chips. We need more. Everybody gets into making AI chips. AI chips that should be selling for $7,000 like an H100 sell for $30,000 to $40,000 or $50,000 or $60,000 on the black market or even more. Then all of a sudden, everybody gets into building capacity and manufacturing chips. Everybody gets into competing products. The prices come back down to reality until you turn into like a lithium, commodity where all of a sudden prices completely collapse and it actually becomes a lot cheaper to build out the infrastructure. Okay, well, that's normal. The problem, though, is when you have an ego and you don't adapt to more supply, like the growth of a Luckin Coffee or the growth of labor supply. See where I'm going with this? You actually end up missing out on the warning signs that prices and wages are potentially about to collapse. I'm just using Starbucks China as an example because these same things I think are going to happen in the United States with wages and inflation in the second half of the year. Now, we have to wait and see, are those actually going to happen? But this has a very real possibility based on just the data we're looking at. Look at this. So watch the ego again. We're seeing intense price competition. So is Starbucks reducing their prices in the face of, as we have special situations here on Twitter or X posting about how cheap coffees are in China from companies like Luckin Coffee or otherwise? A lot of competition. What's Starbucks' response to this? Starbucks' response is, we're choosing not to participate in that. We are a premium brand. We've built a business over 25 years with a great deal of competitive advantages. You could see that there. We have amazing partners in stores. We have stores that look distinctive. We have a tradition of coffee. Oh my Lord, the ego. We are traditionalists. We're a premium brand. We choose not to participate in lowering prices. You're gonna get screwed. And you're going to realize it too late, and then you're going to drop prices too late. And guess what happens? When you drop prices too late, you're behind the curve, and then you're screwed. That same exact thing can happen with jobs in America. Jobs go first. It happens slowly. Jobs go first, then earnings roll over. Jobs go, earnings roll over. Earnings roll over, less people hire the people who got laid off. Then you have a recession. Then we potentially go into real estate foreclosures on people who financed homes in 2022, thinking it would always be easier to just resign and get another job because the job market is so intense, and they've got a 7.5% loan. And then what happens? They're like, oh, well, rates will come down. I'll be able to refinance. Good luck refinancing without a job or a whole lot lower pay. So what potentially happens in the market as the job market rolls over, which is, I think, what Jerome Powell is starting to see, and we're definitely already seeing at the recruiting firms. It's not actually a wage price spiral concern. It's potentially actually the opposite. It's that wage gains actually go negative because people start being willing to work for less just to get a job. So how does that screw the middle class consumer when companies start realizing they're going to be forced to lower prices as supply chains stabilize? Eventually, we're going to get this mass disinflation, potentially through a recession. This is why I'm a little struggling. It's kind of like, okay, like, yes, we've got some hotter inflation numbers now, but that's holding up because the economy is holding up, GDP is holding up. But again, as those prices start rolling over, earnings growth rolls over, those layoffs increase like we're already starting to see, then people don't have jobs, then people can't buy, then that leads to a self-fulfilling cycle of less hiring. Then you run into real problems. And who is it a problem for? Or should I say, whom is it a problem for? Well, it's a problem for the middle class, the person who's working. Maybe they're making somewhere between $50,000 to a couple $100,000 a year. I know that's a broad range. That's why we call it the middle class. The lower class, obviously, we want to see you get into the middle class. It could be an opportunity to get in, but it gets harder to get in because you have to have now potentially the ability to acquire more skills to level up and be willing to work for less. That could be a way to get in, right? So let's say somebody else is a computer programmer, software engineer, and they're like, I need $200,000 a year. And you graduate and you're in a lower class and you're going, bro, I'll take a job just for 70, like just get me in, right? That actually does give you an opportunity to level up. But that means those 200K programmers are like, crap, I'm going to have to go down to 100 just to get a job again. That means I have less money to spend on stuff. Not great. That's where you could actually see negative growth in pay. And that's kind of what we started seeing in the report today. A miss not only on the number of people getting employed, but also a miss on how much wages were going up. So what then happens to stocks and real estate? Ah, yes, stocks and real estate. Well, I hate to say it because it's not what you would expect. If the Federal Reserve starts rapidly cutting interest rates, there are going to be massive changes in real estate and the stock market. As of Wednesday morning, the market was only expecting 1.2 rate cuts this year. After this morning's jobs report, the market started expecting 1.9 rate cuts this year, rounded up from 1.87. That's problematic because it's an indication that the market's going, oh, wait a minute. Maybe the jobs market isn't as strong as we think it is. Maybe we do need to get rate cuts. I understand the market feels bipolar, right? And I'll tell you kind of where like my head is in all of this. But I think as we get rate cuts, guess who's going to benefit? The wealthiest are going to benefit. The people who have the ability to go buy real estate, the people who have cash to go buy real estate, people who have the ability to go buy the dip, the people who have the ability to hold on to their stocks, and as rate cuts come down, interest rate sensitive sectors start potentially rebounding. And the stuff that wealthy people spend money on, like durables, like fancy cars, premium cars, new cars for their friends and family, solar panels, solar inverter, whatever, houses, that's where you start seeing that spending again. The people who aren't worried about losing their jobs, or even if they didn't have a job, they have enough capital to keep spending. And so that's where the rich keep getting richer. The people who get screwed are the middle class, because again, the lower class can pop in and take jobs from the middle class at a lower cost and get into the ride of being in the middle class. People get screwed are the lower class who start now getting replaced with people willing to work for less. If they lose their job, it's much harder to get another job. Now they have less capital to go spend and invest or buy cars or buy real estate or whatever. And the dreams of refinancing at lower rates when rates come down, poof, because your wages just went down. Now your debt to income ratio is too high anyway. This doesn't actually mean that you're going to have a real estate crash. It's possible if you have enough foreclosures, but you would really need to see enough foreclosures and enough of an inventory move up. Personally, I think we're going to be a little bit more sideways in the near term, but you never know. We didn't see the kind of crazy lending that we saw in 2006 in single family, seeing some more of that in commercial and multifamily, which creates some really good opportunities, in my opinion, to buy the dip. You just have to be careful that the dip doesn't keep on dipping on you. But this is, in my opinion, a real warning to the middle class that I'm personally worried about. If I were in a situation where I was working for, say, $120,000, $200,000, $70,000 a year, whatever, I'd be thinking to myself, okay, what do I do if I lose my job? Well, first of all, I don't want to lose my job. So I'm going to try to figure out everything I can to make sure I provide as much value as possible. And I would also start getting really satisfied with my current job and being there for the next at least probably 2 years, 3 years, somewhere in there, in that window. So like if you were itching to like go to a different company, I'd probably really be thinking about, okay, what can I do here to provide more value for the next 2 or 3 years and to make sure that I'm not part of the first layoff cycle, or rather the next layoff cycle, right? So I'd be buckling up going, hey, what can I do to provide more value to the business? Do you need any licenses? Do you need any, I don't know, need somebody staying after work or before work or whatever? You got to become irreplaceable now. I'm purposely trying to create that wording now. It's not to fearmonger, it's to hedge. Maybe nobody loses their job in your company. Maybe the economy just keeps booming and everything just goes to all-time highs. But would it not be better to buckle up and hedge, provide more value at your job, get some more skill sets? You're a bookkeeper, become a CPA. You're a junior software programmer. What certifications do you need to become a senior software programmer? You're a real estate agent. What do you need to become a broker, an MLO? See what I mean? Like, you're a registered nurse. What is it going to take to become a doctor? I don't actually think healthcare is going to have as many problems, but it'd be nice for you to have more capital in the event there's a downturn, right? So what can you do to increase that income, that top line? That is so important right now, and it's exceptionally important because if the leading indicators with today's jobs report continue on this trend and inflation starts rolling over, we're going to see big rate cuts, but we'll also see that those massive price declines will actually potentially roll into disinflation, which I know is counter to what we've seen so far in the inflationary trend at the beginning of this year, but it's a possibility. And then that's where job cuts come, because now all of a sudden your year-over-year revenue numbers start going down rather than up. Like, you don't have the tailwind of inflation actually helping you beat on earnings anymore. You're missing on earnings. So I made this little chart over at ehack.com. It's not really a chart, it's more like a list. But anyway, I wrote Kevin's sentiment indicator for the last 2 months. So I wrote 1 is Kevin is full bear, 10 is Kevin is full bull. So then I give some examples. 10, COVID by the dip. Kevin refinances all houses in March of 2020 and YOLO's on Larry Kudlow's V-shape for the stock market. I made a lot of money doing that. That was good. 1, which is full bear. January of 2022 would have been a full 10. I was making Titanic sinking videos and suggesting bonds, SPACs, and stablecoins would collapse. And banks, honestly. Watch that video. Just type into YouTube, Meet Kevin Titanic Market Crash. You'll literally see me predict bank failures, stablecoin failures, all dressed up in a Titanic video. It's probably my most epic video. 2.5 would be early March 2024. This is going cash. I'm a bear. Hot data for January, Feb. I'm like, this isn't good. The Federal Reserve is going to pow us. This isn't great. Then we get and we have earnings coming up, which could be bad. I go to 5 on the first week of tech earnings because of confidence and guidance that the consumer so far is still holding up, though I'm diversifying, right? I think it's important to note. Also, though, diversifying, owning more stocks / less concentrated on singles, right? So broadening out. Second week of tech earnings, I go to about a 6, and after Jay Powell, I'm about a 7.5 in terms of bullishness on the stock market. So I'm not like full perma bull here, but you can kind of see this transition. You can go to ehack.com and read the whole thing if you want. But that's kind of how I feel right now, where I'm still more cash than like a full bull, but I also have concerns. Obviously, inflation could run up. Our next report will be March 15th. Obviously, coupon code expires today. Finally, sorry, we had to extend it a little bit. There were too many emails. Emails at staff@meetkevin.com for questions or bundles. And then obviously, Jay Powell was pretty dang dovish. Why was he dovish? Well, we start looking at some of these earnings reports, which soon we're going to be getting the next earnings report for ZipRecruiter. That'll be really interesting. We get that in 6 days. We're going to have a lot more data that's going to say, hey, is this job situation about to become a little bit more serious, or are we going to be able to keep flying this plane? So we'll have to watch for it. Some folks are saying Bitcoin is starting to snuff it out. I don't know how particularly true that is, but Bitcoin did roll down to almost $56,000 there for a moment. Actually bounced off one of our lines. It's at 62 today on that better jobs data. Still getting some recovery here, but that bounce over there, that 57.5-ish. Some people are saying Bitcoin's starting to snuff out some potential issues in the economy, though I actually think that when we get rate cuts, Bitcoin, along with a lot of risk assets, will actually do quite well. You just have to be careful because some company earnings are really going to collapse, probably like your staples, McDonald's, Coke, Costco, stuff like that. But the interest rate sensitives, I expect, will do quite well. The Teslas, the Enphase, whatever. Again, because they're like wealthy people, money spending companies, money recipient company. Anyway, you get the idea. Anyway, that's my warning. I wish you the best. Good luck. If you like my perspective on building your wealth, check out the courses linked down below. Remember, you get access to all the course member live streams going all the way back to like 2017 and all the future course member live streams we do every day the market is open at 5:25 a.m. With rare exceptions. You also, in the Stocks and Psych course, get all my trade alerts, buy-sell trade alerts. So if you wanted to be part of those, the last 2 trades I did, I have to say, very proud of. The trade I just did this morning was a 20K P&L, and then the trade before that was $511,000. I turned 100 into a 500K gain, so I turned 100 into 600. That was crazy. That was really cool. I could have had that same ratio if I had the same balls this morning, but I went with a smaller bet this morning. Anyway, yeah, so this is... Check those courses out, linked down below. Thank you so much for being here, and we'll see you in the next one. Stay tuned and buckle up.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than HouseHack, nor am I presently acting as a market maker. Make sure if you're considering investing in HouseHack to always read the PPM at househack.com.